Good morning. This is a recreation of a presentation I did for AXUG on the Phoenix Summit in 2018. This presentation is basically really in going into detail to really help you understand the revenue and costs that can be associated with purchasing to help you create what I would define as a fully built up cost. And we're going to look at traditional methods that are pre-AX 2012, and then we'll look at the methods that are 2012 and beyond into D365 finance and operations. I'm Don Riggs. I'm a Microsoft MVP, and my company is Business Process Improvement. So this is just a little bit about me. I guess what's important to note here is that I've been involved with AXUG for a number of years. I've been in the industry for well over 30 years and working with the Dynamics AX product and all of its derivations since then. For 14, 15 plus years. I've been awarded the Granite Award for partner participation. Also, that for 2016 also was awarded in 2018, and I'm selected by Microsoft as Microsoft MVP for 2017 and 2018. I love what I do, and I'm very much interested in helping really give some of my experience out to the people. Okay, so here's our objectives for today. The first one is really we're going to talk about what are the components of cost. It's very important to understand if we've got cost elements, what are those elements that we should be trying to at least apportion part of that value into our cost. How do we use miscellaneous charges as an allocation method? You can use what's called an automatic miscellaneous charge, and this is anything pre-2012. This was the only way you could do things like allocate for freight. And we're going to make sure you can go through and understand if you happen to be a pre-2012, how you might do some of these things. Then we're going to look at the cost allocation for purchase items. With 2012 and beyond, you have this concept of a purchase roll-up. Quite frankly, that was a new concept. I've never seen it applied quite that way, but you actually can roll up based on your purchase cost and also through some allocation methods or an application of an overhead factor. You can, in fact, add that to the value of the inventory, both in the calculation of a standard cost or grabbing that information as an allocation on an actual cost when you actually receive a purchase order. We're going to talk a little bit about allocating warehouse operations. I'm going to suggest to you that there are different ways of thinking about this. And I've heard different views of whether or not you can allocate warehouse operations to cost. I'm just going to show you some ways that you can do that. Then we're going to talk about freight cost. How do we manage or how do we identify freight cost? And how can we get them into part of your cost for that individual item? And then really we're going to talk about what happens when we post the cost, when we receive, let's say, the purchase order. So for cost, I think it's important that if we look at revenue and we look at more important profit, because that's how we really need to gauge how successful we are, we need to truly understand what are the components of revenue. And then once we look at costs, what is our margin above that? So part of what revenue is what we actually sell it for. So we sell it for, let's say, $100. It's important to note that the discount itself, so let's say if you have a discount structure, that discount can either showed as an independent element or netted. I tend to like to see it netted. I'm not sure why a discount you'd want to see independently, but just so you know, if you don't set up a discount account, it will net the discount with your revenue account. The other thing you have to consider are other costs, and those are things like commissions. So commissions should be an adjustment of the cost of goods sold. Some allocation of rebates, if you're using a rebate module for your customers, need to be considered. And things like terms discounts is a factor on reducing your overall profitability should the customer take it. So now we're going to go through and talk about what are the components of cost. So if you look at the cost of inventory, really, if you look at the cost of products or raw materials, a product that differentiates there is something where you've got a value-added process, like a manufacturing process, or what we'll call a raw material, something you purchase from the vendor, but you do not add value to it, or you use it in your value-added process. It really needs to think about, how do I include freight or shipping charges? So those are legitimate costs that can be associated with that cost of that item. And it can vary from where you get it. So if you really think about it, when you order something, the cost from the vendor can change, or depending on where you order it from, the cost of the freight or shipping charges can change. So the more we can allocate those charges, the better off we are, provided they're fair. You can consider, and I'm talking about the cost, and whether you apply it to the cost or not, you do have a cost of storing products, and that's called like an inventory carrying cost. And the cost of managing that warehouse is a cost that may or may not be applied, but you need to be aware of. Is what does it cost me to do my warehouse operations, my shipping, receiving, and what's my carrying cost? And so we really in the industry are always wanting to streamline the inventory so we're not carrying a lot of inventory that's not moving, because it takes more space, it costs more to move it around. There's a number of factors when you're looking at inventory cost. Direct labor cost. Okay, that's from the production side. You have a component of direct labor. And of course, if you know, as we've talked about, you have your material cost, but your cost of direct labor, and then you have factory overhead expenses, which can be stated as a percentage, usually related to materials or some manner of direct labor costing. So think of those are a factor that we can add to absorb the additional factor overhead. When we talk about overhead, we're talking about electric, light, floor space, fair allocations of cost that can then project out what your true costs are on a per item basis. Then last is you really need to look at, where I don't know if you call it depreciation or more amortization, but I'll give you a good example of that's something that people do a lot, and that's the actual amortization of a tooling. Let's say you buy a tool and it's good for 500,000 hits. It is quite fair to take your tooling cost and apportion some of that on a per each type basis. So you would amortize that over the 500,000, and that would then become part of that cost for that particular tooling or stamping process. So cost of transportation. Really, it's one of the hardest things to do, and it's one of the hardest things to account for. What's very important is if you know it, you can post it on your purchase order, and then you can allocate that across your lines. You can allocate for it and then compare it to the actuals. Or lastly, you can go in after the fact and update these costs, as long as you understand that they are posted at a separate time. But if you do it in the same period, you can in fact get that into your ledger. So there's all three of those ways. Now the transportation module has some integration that allows you to amortize cost across these, but you have to be using loads. So you have to be saying what came in on the load and then associate that freight bill to the load. So it's not widely used at this point, but it is available, and I'm sure they're going to be improving it in future versions. Cost of goods for retail, or for resale, excuse me. So if we look at trade discounts, that's really just a discount you're allowing regardless of type of payment. In other words, it's a discount on the sales order. So therefore, I'm more used to people using more what I call a contract price than a discount structure. But effectively, if you can use a discount structure, that's an easier pricing algorithm usually to set up. So trade discounts are part of it. That's a discount I'm giving this customer for this product based on this quantity. Rebates. It's really a rebate is something that is based on the purchases during the year. And keep in mind, you have a rebate you can get from the manufacturer, which actually should increase your revenue or reduce your cost of goods sold, and you can allocate for that to some extent. But also you could offer your customer a rebate. So therefore that then would reduce your profitability. Then we talked about cash discounts, and cash discounts are usually applied to encourage prompt payment. And then commissions, and that's what we're paying to salespersons and your agents, and so those are the main ones. But you can have, and the name escapes me right now, I'll come up with it in a second, I'm sure, but something royalties. You might be paying royalties to somebody like a Disney. That is also part of your cost of goods sold for resale. So now let's look at manufacturing itself. So manufacturing are parts, raw materials. And when I talk about parts, I'm talking about semi-finished goods, because we might go through multiple levels of a bill of material to produce an ultimate finished product, and all those accumulated costs go into the final product. And supplies. So a lot of times we may allocate for supplies. You typically expense for supplies unless you can get them some way into your bill of material structure. But in general, you understand that supplies are a legitimate cost of the manufacturing process. Labor. And when we talk about labor, we're talking about fully built up labor costs, including fringes and benefits. And then overhead, and that's how we get that fully built up labor cost, quite frankly, is usually we're using an overhead calculation to account for that, because we use a standard labor kind of structure that says this activity has this labor amount. You could have that as a fully built up cost of labor rather than overhead, but it's hard then to differentiate. You have to break it back out on the back end. So normally what we're doing is creating some manner of overhead structure that will allocate for these additional costs. Then we can compare the actuals with what we call the absorbed to give you over and under absorbed. And that's an old way of thinking about it. I'm not sure how much they're using that in modern thinking, but it always is good to look at the relationship of the overhead you're actually consuming compared to the overhead you're actually using for a period, your expenses you're actually using. So now let's talk about cost of goods other. Really, these are indications of they may be tangible cost or intangible cost. And, we had this concept of activity-based costing at some point where we're trying to allocate some more things through our process, which has met with varying degrees of success. It was a real big deal back 10, 20 years ago. But things like tooling, packaging, fees you pay for expediting. We already talked about payment terms and cash discount. You've got the concept of what is your tax rate associated with this. Your cost of communications. Of course, we talked about the inventory carrying cost. So what does it cost you to have that inventory? So those are all factors that you may, with varying degrees of success, allocate into your fully built up cost. But all I'm trying to do is to illustrate all the different possibilities and considerations that you have. So, so really, when we talk about, in my way of thinking, what a fully built up cost represents, is it's a way of allocating those costs that can directly applied to the item itself fairly. And there's a lot of schools on thought of this. Production people don't want you allocating much, and even salespeople don't, because the more it costs, the harder it is to sell, and many times even the less the profit. Depends on the market. So you don't want to price yourself out or use it as a vehicle to say we want to buy it internationally than using our own resources. Because I think the investment in your own resources sometimes is hidden in other factors such as quality, delivery, availability. So you've got to weigh whether you build or buy is really what it comes down to, and whether you buy domestic rather than international. You need to factor in everything into cost, just not the thing that seems to be the most attractive to you, or you shouldn't use as a way of forcing a decision. You should use it as a way of making the best decision for the company. So what's the benefits? Here's what I found in being in this industry for a long time. The most important thing for people to understand is what their costs are. And I've seen it happen time and time again. You've got a small company, very profitable. As they grow, they're trying to absorb more market share. They don't truly understand their costs. And by the way, their costs as they grow go up significantly. And without that true understanding of their cost, pretty soon they're selling jobs that are not profitable. They're not meeting the proper margins, or they're even losing money. And I don't care how you look at it, no matter how much you sell, you're not going to stay in business that long if you're losing money on every transaction. So it's really not about revenue, it's about profitability is what we really need to use as our guideline for how we're doing. I've always believed in business, it's not how much you sell, it's how much you keep is important. And that's proved pretty with me, it's worked out fairly well. So we got to identify the identification of profitability by item, because remember, you can be very profitable on many items and unprofitable on other items. And you really need to understand that if your mix changes significantly, you could go from very profitable to unprofitable just based on that mix. And your biggest exposure a lot of times are new products, and in some cases existing products where you're getting more pricing competition. So I think it always benefits you to be innovative, bringing new products into the channel, and understanding that sometimes we do things to complete the offering, and some may be less profitable than others. At least we need to identify them so we're not bidding lower on the ones we're not profitable on, unless it's to secure some other business. So the first thing to lowering costs is to understand what they are. I mean, you have to understand what they are to start to understand. If nobody's watching it, well, then nobody's really looking to improve it. And there's any number of ways to improve the efficiency there. So better understanding of where the true profits are coming. What that means is, what products are you making money on and which products are you not making money on? You may want to focus your efforts on the more profitable products, is what it really boils down to. And again, no matter who you are and what you do, very seldom are going to be in a business where there's no competition. And if anything, the larger you get, the more competitive that will become. So you really need to understand cost and to a large extent, understand what else is happening. You don't want to be the one that takes the bad deal. You want your competitor to take the bad deal, is what it boils down to. So now we're going to talk about the use of miscellaneous charges at allocation method. And this is still valid for D365 and below, but some of the methods I'm going to talk later were not available in 2009. So this would be the primary way you do it for 2009 and below. Okay, what are miscellaneous charges? If you look at a miscellaneous charge, it's an additional charge that can be added at the header or the line level. Now, at the header level, it applies for the whole order. That might be an order service charge, let's say, or an expedite charge, or something like that, or a freight, if you're able to get that. Now, the header can be allocated to the lines, and that then can be considered as part of the inventory cost, just so you know. And so if it's usually at the header, you're allocated by the lines. And usually I prefer the method of value. The more expensive that line is, the more we allocate it to it. But there's other allocation methods. So from the standpoint, you can post to a ledger account, a customer vendor, or an item on the other side. So think of it as you can post to ledger accounts, and where we're usually a lot of times posting to the ledger accounts is where we're trying to allocate freight in, but we're not necessarily applying it to inventory. A second example where we're allocating it to freight in, but the offset is going to inventory. And when we get into customer and vendor, it is a charge that's going to show up in the accounts payable or accounts receivable. So therefore, if it's an actual charge on the customer order or the vendor order, that becomes part of the open item. But if it's one I'm allocating, then the offset would be the ledger account, and you either go to two ledger accounts or to the item in a ledger account because it does not impact your open items. And a typical example of that is a freight allocation. So just so you know, anything that hits the inventory side will add value to the received inventory. So therefore, it would be part of the component, if you do the allocation, that it would produce an actual cost, so to speak, or in the case of a standard cost item, could in fact produce a variance, provided you don't have that allocated in your standard cost. So again, we talked about it before. It can be an actual or represent some manner of accrual. And really, if you think about miscellaneous charges, I've used them so many different ways. It's, in my way of thinking, it's really one of the most powerful features in AX because you can apply them automatically. They're complex to set up, but when you talk about freight accruals, you know, there's some ways you can set them up automatically that make it for product groups and for item groups and those types of things very powerful in being able to allocate. Charge codes. So when you think about a charge code, they're a definition of a type of charge, like freight allocation would be an example, or a tooling charge could be an example. So think about any charge over and above the price of that product that you might absorb. That is then usually is best handled as a miscellaneous charge. And there's a lot of reasons why people do it differently. One of them is for visibility, but really the charge code is the best way to make the plumbing underneath work. Now, again, as we talked before, they're distributed in three different areas, can be either side of the ledger. They're going to customer vendor, depending on whether it's a purchase order, sales order, item, or ledger account. And then you also provide for a minimum to prevent small charges. You don't want to be charging cents and things like that. You typically can provide, particularly on the sales side, for a minimum if you're calculating particularly on an automated basis. So here's an example of a rebate accrual. And what we're doing here is, in this case, what we're doing is we're hitting the ledger on both sides. So one is reducing a revenue, the other was hitting something like it could be a freight allocation. And really what I'm suggesting here is that really what we're trying to do is to compare the actual freight with the accrued freight. So if we look at freight in, we would post and some people offset it, some people mostly do it in two different accounts. I would have my actual freight, and then I'd have my allocated freight, and I could see through my process how much of my freight associated with products coming in for resale am I covering through my allocation. A lot of people do it this way because it's very hard to always allocate a component of freight to a specific line in the industry. So it's a very legitimate way to get that cost in. So here is an example of a customer or vendor charge that's on, and let's just leave it at vendor, right? But it goes either way. It really allows us to say the vendor charged me freight and I want to allocate it to the item. Freight charged by vendor expensed. So now, rather than associating the freight charge with the item itself, I'm hitting a separate expense line. I just want to show you the examples. I usually like to apply it to the item itself if I can. And here's a freight accrued and allocated to the item. So you can see here, here's your purchase freight, and effectively the offset's going to hit the item. So I will actually have accrued for it, and it'll post against the item. So charge groups. What charge groups is, they're basically allowing you to group certain elements together. Like you might have a group for an item that says, for this item, and these are primarily using automated miscellaneous charges, we can, in fact, for this group of items, this rule applies. And also then it's just a way of simplifying. So here we're looking at vendor charge group 1. So this is a vendor charge group. We're saying for this vendor, this charge group applies. So think of it, it's going to be at the vendor level. And then you also have the ability of having then at the item level, grouping certain like items together. Because you can imagine if you had to just independently for every vendor, every item, create its own unique automated miscellaneous charge, that could be pretty tedious. So as much as you can group them together, the better off you really are in the long term. Okay, now we want to get into automated charges. Again, they can be placed on the header or the lines. We talked about the charges at the header level can be allocated at the line level. You basically have selection criteria that provides whether the charge applies or not. In other words, it's this vendor group in this item, or this vendor in this item group. It's one of those criterias that's going to be providing for the selection of that. Keep in mind, if you've got an automatic charge at the header, it can only be a vendor or vendor group that can drive it. Whereas if you've got it at the line level, it can be the vendor, customer, and the item that can be part of the calculation. it provides for the calculation basis, and that's an amount or a percentage is usually associated with it, and then it automatically inserts into the order. So you don't have to put them in manually. It will automatically come in, and that works very well in things like allocation or charges that are traditional for certain product situations. So here's an example. Here's an allocation for vendor rebate, and what it's saying that when you have a vendor rebate group, and this would be, you'll notice that this at the header, it's going to create a rebate charge of 5%. So these groups that are offering a rebate, these vendors, it's going to put a 5% miscellaneous charge on there. Now here's one at the line level. So what it's saying here, for all vendors, for group freight allocation, it's if the charge code freight allocation is going to have a charge 3% of the value of that line as a miscellaneous charge. Therefore, an allocation of some manner of, in this case, a freight allocation. So it adds 3% to the value of that order, which can be then passed to the item cost itself. So now we're going to go through and look at the allocation of freight charges to an item, so we get a better idea of how that looks. So, so here we're looking at freight, and what it's doing here is we're looking at it's an item in the customer vendor side. So now we create a purchase order, and what we're saying here is if we do this, we're going to create this freight allocation automatically. So when you look at it then, the vendor invoice will actually show the freight charge. And here's your charges. You'll notice you got a charge of $100 over here. Now here's where we enter the freight charge at the header. So what we're showing here is here's a freight, and it's $100 freight charges. So this is on a purchase order. So we've said the charge is $100 that the vendor is charging us. What we do here is that if you've set it up so that the offset is inventory, which you saw in the example, is it will make you allocate the charges to the line levels. If it just go into expense item, it will not have you allocate. So if you've got it the other side pointing to the inventory or item itself, it will make you allocate. The allocation then will take the freight at the header and allocate it typically down the different lines. And then really, this is the allocation method. This screen will come up when you hit that. By the way, I do not believe in certain versions it came up automatically. You had to hit it, but it would make you do it before you could process the vendor invoice. But what this screen comes up in allocating the charges, this is the method I like to use, and I usually allocate the net amount across all lines. So it's what it's saying is that if one line was you had $100 and one line was 40% of the total and one was 60%, you would charge 60% of that freight or $60 to that line for the freight allocation and $40 to the other line. So now if we look at our PO voucher, we're actually looking at the $100 right here. Is that $100 got applied to the item itself as a miscellaneous charge, and that was allocated to inventory, is what you're seeing here. So you're seeing that both go into inventory. You've got the 202, and 2 was another, looks like it's miscellaneous charge or something like that. And then you've got the 102 also getting allocated. So when we look at the inventory transaction then, you can see where you've got the 102, and that's your allocation of that freight charge, then hitting your item is really what we're doing. So we hit it with $2. So that really completes, and spend some time playing around with this, but what I'm going to show you now is my way of thinking, the preferred method, and originally not a lot of people really understood this. In fact, I was one day just playing around in 2012, and I identified that we had this whole purchase order structure in our cost sheet that I had not seen documented any place. And so it really allowed me to expand my thinking about purchase items. So that's what I want to share with you now. So now if we look at our costing sheet, I just want to review the costing sheet with you a little bit, is that you have material cost, production cost, and overhead cost really in your costing sheet. These cost groups come from their standard inventory setups. The most important thing to understand about a costing sheet is it's really one of the only places I can properly apply some manner of indirect cost is through the costing sheet. You can see these others really come from the BOM and route, and they're just represented in the costing sheet. So here's an example of a costing sheet for purchasing. So what you're seeing here is the setup for the costing sheet in purchasing. So it's got to, at the root, add a cost of purchase element if you don't have it. All I'm doing here is subdividing my materials so that when I look at this in a costing process, I can identify the type of materials. But here's where the magic is. We're also saying that we have the ability to have an overhead on a purchase, which means now I can apply an overhead factor, very important, to my purchase so that I can possibly absorb, or not possibly, I can absorb some of these costs that are allocated through my process. And why this is important? The problem we have with miscellaneous charge is that on a standard cost item, unless you're going to override the standard cost to be inclusive of this, it doesn't calculate it. You would have to plug it, so to speak. So if the vendor charged $100 for something and you were providing a 3% allocation for freight, you would have to change the standard cost to, you'd have a purchase price of $100, a standard cost then of $103 to really then account for that purchase allocation you wanted to add to the item. Otherwise, it would always create a variance in a standard cost. Very important, because one of the biggest complaints we had in that utilization, how we did it before, the standard cost you want to be 103, so if you get a variance, it's something that operated outside of your anticipated process. So when we look at this, I want to go ahead and give you a better breakdown of an example that I want to show you. So what I've got is I've got my standard elements here, but what's important, I've got one that's a percentage of person price and one that's a freight per pound, which is pretty exciting when you come right down to it. Well, it may not be to you, but it's exciting to me. I enjoy costing and the complexity of costing. I have methods. So let's talk about how can I use these, how do these overhead calculations work? Okay. First off, they're unit-based or surcharged for this example. So a surcharge is based on a percentage of cost. In other words, it cost me $100 and I'm going to charge $3 or so a percentage. Okay, it's based on a percentage. So I'm going to charge a percentage as a surcharge. So I might have $100 and I've got a surcharge of 3% based on the material value. The other one that's really very exciting is unit based. And what that means now is that I can base a charge on a unit of weight, volume, or a per each. So normally most people think about freight per pound or freight per ton. So I think you get an idea of what we're doing here. Most of the time I'm seeing freight, like particularly in things like chemicals. So it's so much percent, like 3 cents a pound or something like that, I'm used to seeing. So you define this in the item master, but this allows you now to, by the units received, do an allocation of one of these elements. And quantity is more or less a per unit that I might use to allocate the freight. So it's allocating on a per unit, and volume obviously is the cubic volume of something. So in what I'm also trying to suggest to you is that obviously it has to be granular down to the unit level, because all units can weigh a different rate. Or if you look at chemicals, I think it's based on their specific gravity or density, but you could have a series of chemicals that could have the same freight amount, whereas certain lighter ones could have a different cost per weight. And here's the first example. This is a surcharge, which is a percentage of the purchase price. And what we're saying here is for this, and it's really saying the material cost, and we're saying that for site 1, it's 2%. For site 5, it's 3%, and we've got a pending out here. So we're saying that the surcharge and controlling the surcharge by item itself, or down to the site level, I guess, is what I'm really suggesting here. So now we're looking at unit base. So what we're saying here is that on a unit base, it's a unit based, I'm calling it freight, and the description is freight per pound, and the subtype is weight. And all per item does is says, I want to be able to set this up on a per item basis if I need to. And this is how that then looks within the actual costing sheet. You can see freight, and in this case, I've got, and remember, I can do it for table, all, or or individual. And this is saying for this particular item, it's 3 cents per pound. So, and where it comes from is, notice your gross weight here. So we're saying it's one of something. So whatever relationship you have there, so it's 1 pound is what we're saying for this unit. So this unit itself would allocate 3 cents per. Now remember, that could be based on gallons. So it'd be 3 cents per gallon. So when we look at weight measurements, it's not necessarily identifying it other than it's relative to whatever our base unit of measure is set up for. And you got the same thing here with volume. It will create a volume calculation, and that's how it would drive that. Now when we look at the purchase order, we're buying 10 at a unit's price of $22.99. So we've ordered and received at the $22.90. Now what you're seeing here is an additional cost of $460, which actually then adjusts my inventory up to $234.50, and that's really what's happening here. So that's coming from an allocation or an overhead factor that says, okay, we take the amount it actually got sold at, we add this, and we post that to the inventory side. So again, now we're looking at the vendor invoice lines. And so here's where we've invoiced it, process the vendor invoice. And now here's where it reverses out and posts them back in, but you get the same results here. I just wanted to show you, you get that 234.50 is now the value of that item that comes into here. So that's the value of the received item. So now I want to cover the after the fact posting of cost in already received inventory. And a lot of people don't know this either. It's a pretty clunky process. I don't really like it much, but the fact is it is a way to get it in there. It does come in as an adjustment, and I'll show you how that works. In the invoice journal, you can go to charges and do an adjustment. When you do that, then you plug it in manually, and then you need to do an allocation. So that allocation then, when we come into the purchase order and you actually look at the inventory transactions, that's going to come in as an adjustment, and it's going to change your value of the received items. And for all those of you that are familiar with recalculation to account for timing differences, this uses a similar process than that is. So what it's doing is it's doing an adjustment to the value of inventory based on that miscellaneous charge at the transactional level. Now it'll be a separate ledger posting, but it will come in as part of that physical cost that and will be part of that transaction set. So now we look at settlements. So what we're talking about here, I'm going to show you now the only place you can kind of see it. So when we look at settlements, you'll notice this adjustment down here. So when you look, this is where we showed it in the transaction. Settlements tells you where it came from. It will show up in your settlements in your inventory close section, inventory close and recalculation, as a settlement. It's not easy to figure out where this came from this side. But generally it will come in as an adjustment is what it will do. And then when you look at settlements for voucher, you can see what happened here is that $1,000 adjustment to the value of the purchased inventory. Now, if I sold it, it will in fact do an adjustment then against the sales order. And actually, it'll do other adjustments too, but this is the adjustment for that specific sales. Well, again, that's the adjustment for this specific order. So what happened is we went ahead and processed to include the vendor invoice. We sold it. Now this adjustment comes in downstream. Well, if that was based on that inventory that was received on that purchase order, it will do an adjustment to that sales order. The bad news, it may not occur in the same period. So the quicker you can get that freight into there, the better off you are. But one might say it's better to have it and it hit a different period than to not have it at all. So I'm going to let you say what that value proposition is there, but I wanted to make sure you understood it was possible. Okay, so really, I want to talk about inventory close and recalculation and really how it affects. So we're going to go more into just what I talked about. So we look at payroll received, and what we received is 10 at a unit price of $20. Now, keep in mind, we've just received it. We have not processed the vendor invoice. So again, you can see the receive for $20 a unit. Now I process a sales order, and I'm selling it for $40. And what's important, remember, the cost of the unit was $20 at that point. So now when we look at the posting, you'll notice that we are effectively we got one for $10 here, we sold it here. So it used that $10 is what it did for processing the cost of goods sold in that sales order. Now we go ahead and add $20 freight to that. We allocate the freight, and really it was 3%. And really what I'm trying to illustrate here, that notice how your cost amount changes now, because this was on the vendor invoice. And keep in mind, the one thing about these allocation of charges is they do not happen until the vendor invoice is posted. So we picked up that additional $26 that was allocated to the cost amount of this item. So now if we do a recalculation, which as you may know accommodates this, it says, okay, what is out there that got transacted before it got financially transacted on the supply side? So here's what I'm illustrating. We planned it off the purchase order to come in at, I may have the numbers wrong, but let's say $20 or $10 in this case. I then had something occur after the fact, after I've sold it and invoiced it. So now I've got to run a process to figure out what happened or where the differences are and do something about it. And that's what recalculation does. So what it's saying is I've got to do on this sales order an adjustment of $26 to make up for that additional $26 that hit. So what it's saying here is it will post a recalculation ledger posting that, as you can see, will adjust the value of my inventory and hit my cost of goods sold on the other side, increasing my cost of goods sold. So here's the sales order, and you'll notice it now has a $26 adjustment, therefore making the cost of goods sold different. So let's talk about charge code facts. They're extremely flexible and powerful, but the maintenance is very difficult. You can imagine with all the different possibilities you might have, and the biggest problem I've seen is you've got to group them to be relative groupings. And that is hard to get the granularity you want sometimes. So there's a trade-off. You can use negative miscellaneous charges to identify unique transactions. And I'm trying to think of an example right off the top of my head. But you could, in fact, have a vendor rebate, or on a sales side, have the impact of the vendor rebate impact the transaction, which then would be a negative application of that miscellaneous charge. It's actually not a charge, it's actually a reduction of cost you could apply. I think you want to use charge codes where you need charge codes to add to your inventory cost, and then also it's going to adjust your COGS and possibly revenue, because I've had it affect and change revenue. And because there's all kinds of creative ways that people do these things, and that's why I'm trying to say there's so many things. I've used them in so many different applications. And I said before, in charge codes, we got to account for them in their standard cost, or they will produce a variance. Okay, and that concludes this presentation.